Hello everyone. In this practice problem, we are going to prepare a statement of stockholders' equity for Collins Audio Incorporated. Firstly, what is a statement of stockholders' equity? Well, it is one of many types of equity statements that a company can produce. And in recent years, it is gaining popularity quickly, becoming a very commonplace equity statement that companies produce. It is very similar in concept to the statement of retained earnings. By this point in your accounting education, you have made a statement of retained earnings. What do you do on a statement of retained earnings? You show not only what the beginning balance was and the end balance is for retained earnings, but how it changed during the period. What additions did you have to retained earnings, primarily in the form of net income? What subtractions did you have from retained earnings? That's distribution to owners, primarily in the form of dividends. Like the statement of retained earnings shows the beginning balance, the end balance, and the individual changes that happened during the period that took it from the beginning balance to the end balance. Well, our statement of stockholders' equity is going to apply that same concept. Beginning balance plus or minus changes gives you your end balance, but instead of doing it just for retained earnings, we're going to do it for every single account that shows up in the equity section of a company's balance sheet. So here, for Collins, we have a preferred stock account, a common stock account, our additional paid-in capital account. If you wanted to, you could separate this into paid-in capital for preferred and paid-in capital for common and paid-in capital for treasury, but to keep it of manageable length, I'm going to have you bunch it all together into additional paid-in capital. Retained earnings, our treasury stock, our AOCI, our accumulated other comprehensive income, which is income or loss that could have affected our retained earnings but has not yet been realized. Our non-controlling interest in subsidiaries, the people that own a very small portion of our subsidiaries who are entitled to a portion of profits, but they may not want all of that, and they give you some to hold on to. They increase the value of your business by letting you write it out, I guess, to hold on to the profits that could be distributed to them so you can grow the business and make it better. All of that adds up to our total stockholders' equity. And we have the beginning balance for every one of our accounts. We're starting with $1 million in preferred stock, $300,000 in common stock. When we issued those stocks, our now shareholders paid an additional $5.2 million in capital to acquire ownership in Collins Audio Incorporated. At this point in time, Collins Audio has $4.6 million in retained earnings they're holding on to. They're holding on to $700,000 of treasury stock, which is a negative because it's a contra equity account, so that treasury stock is not entitled to our stockholders. It is the companies to hold on to do whatever we want with it, normally try to make a profit. We have $410,000 of accumulated other comprehensive income on our books. We could have realized actual income of $410,000 had we done some things like sell investments, factor our receivables to profit from a translation adjustment, all of that stuff. We have $190,000 in equity, which is attributable to our non-controlling interest in our subsidiaries. And if you add all that up, in total, we have $11 million in stockholders' equity. We have a list of all of the different things that happened during the period that affect one or more of our equity accounts. And we're going to go through and fill them in on this statement of stockholders' equity to show how it's going to change. So in the first one, it says during the year, Collins Audio had $400,000 of consolidated income. So that's income to go to everybody, our stockholders and non-controlling interest that we have in our subsidiaries. Of that $400,000, $385,000 is attributable to our shareholders, while the remainder is attributable to the non-controlling interest in a subsidiary. Well, what happens with income? If you don't distribute it, it increases your retained earnings. You would retain that income. So for that first line item, we would have $385,000 of income attributable to our shareholders, which we funnel into retained earnings. And the remainder, which in this case is the difference between $400,000 and $385,000, $15,000 worth of income, which if we don't distribute it to the non-controlling interest in our subsidiaries, is going to increase their holdings in the company. And I put it on the wrong line. There we go, $15,000. Net income attributable to a non-controlling interest. I have seen this templated where it just says one thing that says consolidated income, and then they both go on the same line. I split it for you to make it easier. Whatever floats your boat. In the next line, we have during the year, Collins raised $1 million of capital by issuing previously unissued common shares. $50,000 of the issue price can be attributed to the par value of the issued shares, and the remainder was paid in excess of par by investors. One hint that I have for you when you're preparing this statement is think about what would the journal entry be for that transaction. Like, you don't have to record the journal entries when you're making the statement of stockholders' equity. They'll already be on your books. But if you know what you did in that journal entry, it tells you what you need to do to your statement of stockholders' equity. What would the journal entry be for this transaction? Well, we're raising $1 million in capital. That would be the amount of cash that we're receiving. So we would go and we would center that. We would stop centering that and move it to the left and for the first place. And we would put that $1 million of capital that we just raised on our books. Well, what are our credits in this case? Our credits are going to be, I'm going to do that. So there we go. Our credits are going to be a credit to common stock for the portion of that $1 million we received, which could be attributed to the par value of the shares that we issued. Our information tells us that's $50,000. And we would have a credit to our paid-in capital in excess of par account, which I always abbreviate to PIC. In this case, it's on common stock, so PIC common for the difference between those two numbers of $950,000. Why did cash get debited? Because cash is an asset, and assets always increase on the debit side. Why did we credit both common stock and PIC common? Because they're both equity accounts, and equity accounts increase on the credit side, which is very pertinent information as we're preparing a statement of stockholders' equity. We know we need to increase common stock by $50,000. We know we need to increase PIC common by $950,000. So let's make that happen up here in the body of our financial statement. Issuance of common shares is going to increase our common stock account by $50,000. And it's also going to provide us with $950,000 of additional paid in capital. So $950,000. The column on the right, total stockholders' equity, shows the overall effect that that line item had on your company's equity account. So when we had $385,000 worth of income, it just increased our overall equity by $385,000. When we had $15,000 worth of income that was attributable to our non-controlling interest in our subsidiaries, it increased our equity by $15,000. What about this one? Well, it increased one equity account by $50,000. It increased our other equity account by $950,000. So the amount that increased equity overall is equal to the sum of all those numbers. And I'm going to use Excel to highlight every one of these rows. $1 million. That issuance increased our overall equity by $1 million. What about the repurchase of common shares? What we have next. During the year, we paid $150,000 cash to reacquire previously issued shares of common stock. What would that journal entry look like? Well, if we're buying shares that are our own shares, not another company's shares, it goes into our treasury stock account. And this is common shares, so we call it treasury stock dash common. Treasury stock is a contra equity account. So it's still an equity account, but it works the opposite way of other equity accounts, which means if other equity accounts go up on the debit side, or go up on the credit side, this one's going to go up on the debit side. For how much? Well, we paid $150,000 in cash to acquire that stock. So let's debit treasury stock common for $150,000 and credit cash for that same amount. And here we see we have a contra equity account going up $150,000. We had this number as a negative in treasury stock to start with because as a contra equity account, it decreases our overall stockholders' equity. So let's type it in negative here. Knowing we need to bring our equity down by another $150,000. So what was the overall effect on our company's total equity? It's going to decrease it by that $150,000. For the issuance of preferred shares, that entry is going to look a whole lot like the entry we just had a minute ago for common shares. We raised $600,000 in capital. We'll stop right there. We raised $600,000 in cash from the issuance of those preferred shares. And GAAP policy says that we need to separate that money that we raised into the portion which is attributable to the par value of that preferred stock and the portion that was paid in excess of that par value, which is our PIK preferred account. So does our information tell us how that's split up? And it does. It says $500,000 of this issue price is attributable to par value. So that goes to preferred stock. And it says the remainder was paid in excess of par by investors. Well, how much is that? If they paid $600,000 and the par value was $500,000, the portion that was paid in excess of par was the remaining $100,000. Again, we've got two equity accounts increasing, and we need to increase those equity accounts on our statement of stockholders' equity to represent what happened in this particular transaction. So the issuance of preferred stock in this case is going to increase preferred stock with a $20 par by $500,000, and it's also going to increase our paid-in capital by $100,000. The overall effect of this transaction had on our company's total stockholders' equity is that it increased it by a total of $600,000. Next up, we have during the year, Collins Audio Incorporated paid $30,000 worth of cash dividends to the company's stockholders. In real practice, there would probably be multiple entries that this would have, like you'd establish the liability on your date of declaration, and then you would pay it and take that liability off your books. Let's do it in one step. We would have a debit to our cash dividends account, which is a withdrawal account for the amount that we are paying, which is $30,000. And we would have a credit to cash for that same 30 grand. And you might be thinking right now, well, there's no equity accounts in there. How's this going to affect our company's overall equity? And the fact that cash dividends is a withdrawal account tells you what's going to do the equity in the long run, because withdrawal accounts are temporary. They need to be closed at the end of every period. And what account do we close our withdrawals to? Let's get this up out of here. And now let's close that $30,000 that we had in cash dividends. They close to retained earnings. So let's go and put the closing entry in that would happen for closing cash dividends. We would debit retained earnings, decreasing that equity account by $30,000. And our cash dividends account, which at this point would have a $30,000 debit balance, needs to get credited for $30,000 to reduce its balance to zero and close that temporary account. So we have a decrease in equity of $30,000. Let's put that into our chart. And overall effect on our total equity, it goes down by 30 grand. It's just the sum of everything in this whole entire row. We have the issuance of common stock dividends. How do common stock dividends work? Let's assume, and you're free to assume in any assignment that you get, that it's a small stock dividend. They work by being paid out of retained earnings. There's a concept called legal capital that says whenever you distribute anything, be it cash or new shares of stock, to your owners, it has to come out of your company's own internally generated profits. You can't take out a loan to pay dividends. You can't take out a loan to buy your own shares and then give them to people. Both of those will definitely raise the ire of the SEC and get you in trouble for violating GAAP policy. So what is the entry typically then for the issuance of common stock dividends? Well, you debit retained earnings, just like you would when you're closing your cash dividends account. And then you would have a credit to the portion of your issuance that's attributable to the par value of the shares that you are issuing, and the portion of market value that your investors are receiving that is in excess of that stated par value. So it's just like the entry to issue common stock in the first place, but now instead of receiving the cash, we're taking it out of retained earnings. It's like we're buying these shares and giving them to our owners. What numbers are we working with here? Well, it says during the year, the company issued new shares to common stock to existing shareholders in the form of a common stock dividend. The market value of these shares at the time of issuance was $100,000. That's super important because whatever the market value is the amount that you're paying to put those shares out. It's the amount you have to debit retained earnings for. The combined par value of these shares was $5,000. Well, the par value goes to your actual stock account, Whatever the difference is has to go into your additional paid-in capital account. So what we're saying here is we just distributed $100,000 worth of shares, or shares with $100,000 of market value, to our existing shareholders at this time. And of that $100,000, $5,000 of it is attributable to the par value of the shares that we are issuing, and $95,000 of the value that our shareholders are receiving is in excess of that par value. We have three equity accounts. One is going down while the other two are going up. So the one that's going down is retained earnings. We'll go to our retained earnings column. That's decreasing by $100,000. Our common stock with a $1 par account is going up by $5,000. And our paid-in capital is going up by $95,000. So what effect in total does this have on our company's equity? It doesn't. The dash is Excel speak for zero. And whenever you issue a common stock dividend, it has zero net effect on your total stockholders' equity, because you are you're just basically converting retained earnings into new forms of ownership. For the issuance of a common stock dividend, the total net effect on your equity is always going to be a wash. It's always going to be zero. Which leaves us with one thing left to look at, and that is our AOCI, our other comprehensive income, or in this case could be loss. During the period, we had to make adjustments to the company's assets that we are allowed to adjust to fair value, like our investment in the equity of other companies, and doing so resulted in Collins Audio Incorporated recording a $10,000 comprehensive loss. Well, what does that look like on here? If you have a loss on there on an asset that's on your books which you've not actually sold yet, you didn't realize that loss, but it's sitting there. So you would have an unrealized holding loss. Your credit in the entry to adjust an asset to its fair market value is a fair value adjustment. Fair value adjustment in this case is going to be a contra asset account. It's going to decrease the value of whatever that asset is that we're adjusting the value of down. And then our unrealized holding loss is going to be, think of it like an expense account. It's not necessarily an expense account, but it's the same basic concept. We would decrease this by 10 grand. And here we're in the same situation that we were with cash dividends earlier. We don't have an equity account listed here, but one of our accounts, that expense account right here, is a temporary account, which means it needs to get closed at the end of the period. Well, if we had a balance of $10,000 in unrealized holding loss and we needed to close it at the end of the period, we would have to credit that account for another $10,000 to get its overall T account balance down to zero. So let's do the subsequent closing entry that this entry would necessitate. We have unrealized holding loss, this time going down to close. And what would you close that to? You could close that to a whole bunch of other stuff, but I personally would close it, in this case, to our AOCI, our accumulated other comprehensive income. That's an equity account, and like all equity accounts, it goes down on the debit side, so we would have a decrease to equity of $10,000. Let's put that decrease of $10,000 into our table. And the net effect of that is that loss decreases the value of our business to our shareholders by 10 grand, because even if we sold the company today, that would involve selling those assets that we are holding that have an unrealized loss tied to them. We would have to sell them, experience that loss, and the amount of money that would be left over would be less than it was at the beginning of the period. And now that we have all of these columns filled in, what we can do is we can find the total of each one of these columns. And to cheat in Excel, I can type equals sum, highlight all the numbers in the column, close the parenthesis. Excel will find the total. Our preferred stock, $20 par, would be up to 1.5 million. And now that I have that formula in there, I can use the fill handle in the bottom right corner, drag it across. I'm going to go just to non-controlling interest in subsidiaries, and it's going to fill in all of my numbers. We started with $300,000 of common stock. It went up by $50,000 when we issued new shares, and it went up by another $5,000 when we issued a common stock dividend. Then that makes sense. The balance should be $355,000 at the end. For additional paid-in capital, we started with $5.2 million, It went up by $950,000 when we issued new shares. It went up by $100,000 when we issued new preferred shares, and it went up by $95,000 when we paid a common stock dividend. So $5.2 million plus those three numbers does in fact derive us as $6,345,000. For retained earnings, we started with $4.6 million. It would have went up $385,000 when we accounted for the portion of the net income which is attributable to our shareholders, and it would have went down $100,000 when we took some of those retained earnings and issued new common shares to people. So $4.6 million plus $385,000 minus $100,000 is $4,885,000. This is the information that will be presented just on a statement of retained earnings. We have it here. We just have it in addition to all this other fun stuff. And the same is going to be true for treasury stock. The same is true for AOKI. If you go through all of the end balances you get right here, makes sense. And non-controlling interest in subsidiaries. And here's the thing where you know if you did your statement of stockholders' equity correct or not. Let's find the sum of all of these numbers over here. The sum of everything added up in the right-hand side adds up to $12,810,000. We know what we started with. We know what increased our equity during the period. We know what decreased our equity during the period. When we account for all of that, the new end balance of our equity overall would be $12,810,000. Well, what happens when I find the sum of all of our different accounts? So we have this much in preferred stock and this much in common stock and this much PIK, this much retained earnings. We're holding on to these many common treasury shares. We have accumulated other comprehensive income of this, and we have this much equity, which is attributable to the non-controlling interest in our subsidiaries. We add all of that up, all the different components we could possibly have in our equity. It comes up to $12,810,000. So this number down here, I've even changed the formatting to good. There we go. This number down here in the bottom right-hand corner has to always be equal to not only the sum of the column above it, but the sum of the row that is next to it.